Hey everyone, welcome back to Sara Retires. Here's something that surprises people. Most retirees are overpaying in taxes, not because they're doing anything wrong, but because retirement quietly changes all the rules. The strategies that worked while you had a paycheck don't automatically carry over once you're living off Social Security, pensions, and your own investments. Today, I want to walk you through a complete, step-by-step illustration of how a well-prepared retired couple can still be leaving tens of thousands of dollars on the table, and exactly what a smarter tax strategy looks like in practice. I'm Sara. This is Sara Retires. Let's get into it. Meet our illustrative couple, Mark and Linda. To make this concrete, let's follow an illustrative couple I'll call Mark and Linda. They're both 67, recently retired, debt-free, and have done everything right on paper. They save diligently, they're collecting Social Security, and they're living comfortably. And yet, without realizing it, they were on track to overpay in taxes by a meaningful amount over the rest of their retirement, simply because their withdrawal strategy hadn't been optimized for this new phase of life. Before we get into their specific numbers, let's cover the core tax tools that make a plan like this work. The core retirement tax strategies you need to know. Roth conversions. This means moving money from a traditional IRA into a Roth IRA, paying tax on that amount now, in exchange for tax-free growth and withdrawals later. Used on its own, it's useful. Coordinated with everything else on this list, it becomes genuinely powerful. Tax loss harvesting. Selling investments at a loss sounds counterintuitive, but market volatility can actually work in your favor if you're proactive about it. Harvested losses can offset capital gains elsewhere in your portfolio, creating more room to layer in other strategies. Asset location. This isn't about what you invest in, it's about which type of account holds which investment. Bond interest and high dividend stocks sitting in a regular taxable account can quietly inflate your taxable income every year. Repositioning those holdings between account types can reduce taxable income without changing your overall investment risk at all. Qualified charitable distributions, or QCDs. Once you're 70 and a half, you can donate directly from your IRA to a qualified charity. That donation counts toward your required minimum distribution, but doesn't show up as taxable income on your return. One of the cleanest ways to give and reduce taxes simultaneously. Donating appreciated investments. Even before you're eligible for QCDs, you can make charitable giving more tax efficient by donating appreciated shares instead of cash, avoiding capital gains tax while still potentially qualifying for a full deduction, depending on your situation. Social Security taxation, sometimes called the torpedo. As your overall income rises, an increasing share of your Social Security benefit becomes taxable, up to a maximum of 85%. It phases in quickly and stacks with your other income sources, which is exactly why careful sequencing matters. Medicare Premium Planning, or IRMAA. Just like tax brackets, Medicare has its own income brackets, based on your income from 2 years prior. Even a modest increase in income can push you into a higher bracket, adding hundreds of dollars a year to your Medicare premiums. Each of these tools is useful individually, but most people stop there. The real value comes from sequencing them together and adjusting year by year, which is exactly what Mark and Linda needed help with. Mark and Linda's starting point. Here's a simplified snapshot of their financial picture. Combined, they're collecting roughly $60,000 a year from Social Security, another $35,000 from a pension, about $20,000 from rental income, and around $40,000 drawn from their investments, bringing their total income to a comfortable level that covers their monthly expenses. Their portfolio includes a substantial joint taxable investment account, a modest Roth IRA, a much larger set of traditional IRAs between the two of them, a healthy cash reserve, and a fully paid-off home. Their monthly expenses are well covered by their current income mix. Here's the catch. They were drawing a chunk of that $40,000 directly from their traditional IRAs each year, blending it with income from their taxable accounts, a fairly common, spread it around evenly approach. It's not a wrong approach exactly, but it's not optimized either, and it was quietly costing them in two specific ways. unnecessary current year taxes, and a missed opportunity to prepare for required minimum distributions, which don't kick in until age 73, but grow larger the longer those IRA balances keep compounding untouched. The goal: find room for a Roth conversion without triggering higher Medicare costs. After modeling several approaches, from spreading withdrawals evenly, to drawing only from taxable accounts, to partial Roth conversions at different thresholds, the most efficient outcome came from doing a Roth conversion up to a specific Medicare IRMAA threshold, while being careful not to cross into the next bracket and trigger higher premiums. The problem: in their current setup, Mark and Linda were already bumping right up against that first IRMAA threshold. So before any Roth conversion could make sense, the real first step was reducing their existing taxable income, creating room to convert without accidentally triggering higher Medicare costs or pushing into a higher tax bracket. In an illustrative model like this, that kind of restructuring can realistically translate into well over $100,000 in lifetime tax savings and a meaningfully larger legacy left to their family, along with a noticeably lower average tax rate over the rest of their retirement, all without changing their actual spending or lifestyle at all. Step 1. Repositioning bond holdings. Asset location in action. Here's the first concrete move. A significant chunk of Mark and Linda's taxable account was invested in bonds, generating fully taxable interest income every year and pushing up their taxable income. Instead of selling those bonds outright, the fix was simple. Shift a portion of the bond holdings out of the taxable account and into their IRAs, while moving an equivalent amount of stock holdings the other direction, into the taxable account. The overall portfolio allocation stayed exactly the same. What changed was where each asset type lived. The result? Taxable bond interest dropped meaningfully, replaced by a small amount of qualified stock dividends, which are taxed at a much more favorable rate than ordinary bond interest. Same risk profile, same overall allocation, noticeably lower taxable income. This is asset location working exactly as intended. Step 2. Pausing IRA withdrawals and shifting where income came from. Next, instead of continuing to pull a set amount from their traditional IRAs each year, the plan paused IRA distributions entirely for the year and shifted all necessary investment withdrawals to their taxable account instead. This single change eliminated a large chunk of ordinary taxable income, since IRA withdrawals are taxed as ordinary income, while pulling from a taxable account can often be structured more efficiently, especially when combined with the next step. Step 3. Funding spending with tax-efficient sources. They still needed a set amount from their investments to cover spending. Rather than repeating the prior year's approach, which had included some short-term capital gains taxed at higher ordinary rates, the plan shifted to selling from long-term appreciated positions instead, which are taxed far more favorably. And here's where tax loss harvesting came in. By simultaneously harvesting losses elsewhere in the portfolio, those long-term capital gains were substantially offset, meaning Mark and Linda could access the cash they needed with a dramatically reduced tax bill on that portion of their income. Results here will always depend on actual market conditions in any given year, but the mechanism itself is repeatable. Step 4. Supercharging charitable giving. Here's a detail that's easy to miss. Mark and Linda had been giving a consistent amount to charity each year, but their total itemized deductions were only barely above the standard deduction, meaning their generosity was providing almost no additional tax benefit at all. The fix. Instead of giving the same amount every single year, they bunched multiple years of giving into a single year, using a donor-advised fund, a vehicle that lets you make the charitable contribution now, get the deduction now, and then distribute the money to actual charities over time, on your own schedule. And critically, they funded that larger gift using appreciated investment shares rather than cash, avoiding capital gains tax on those shares entirely while still capturing the full deduction. The following year, they simply take the standard deduction instead, and the cash they otherwise would have given away stays available to reduce future withdrawals or get reinvested at a higher cost basis. Averaged across the 2 years, this bunching approach produces meaningfully more total tax benefit than giving the identical amount evenly every year under the old approach. Step 5. Now there's room for the Roth conversion. After all 4 of those adjustments, repositioning assets, pausing IRA withdrawals, using tax-efficient funding sources, and bunching charitable giving, Mark and Linda's taxable income dropped substantially, from a level that was pushing right up against the first Medicare IRMAA threshold down to a much lower number. That drop created real breathing room, enough space to execute a meaningful Roth conversion while still staying just under that first IRMAA threshold, avoiding higher Medicare premiums entirely. And because so much ordinary income had already been cleared out of the picture, a larger share of that Roth conversion landed in a lower tax bracket than it otherwise would have, making the conversion itself considerably more efficient. The key sequencing lesson. Rather than stacking a Roth conversion on top of already high income, the plan created space first, so the conversion itself could happen on far better terms. The important nuance. Why do the Roth conversion at all? Here's a fair question you might be asking. If the goal is minimizing taxes, couldn't Mark and Linda have just kept their taxable income even lower and skipped the Roth conversion entirely? The honest answer is yes. If minimizing this year's tax bill is your only goal, everything up through step 4 stands on its own and works well without touching a Roth conversion at all. But the Roth conversion is solving a different, longer-term problem. Without it, their traditional IRAs keep growing untouched. Required minimum distributions begin at 73 at even larger amounts, and those forced withdrawals stack directly on top of Social Security and other income, leaving far less flexibility and likely higher taxes down the road. By converting some of that money now, on their own terms, while there's room to do it efficiently, they're flattening out their lifetime tax curve instead of setting up a bigger spike later. That's the part most people miss. Minimizing taxes in any single year isn't always the real goal. Minimizing taxes and preserving control over your entire retirement is. The honest takeaway. Mark and Linda didn't need a complete financial overhaul. They needed a smarter, more coordinated tax strategy layered on top of a solid foundation they'd already built. That's true for a lot of retirees. The accounts and the savings are often already in good shape. The missed opportunity is in how and when the money actually gets withdrawn, converted, and given away. This is a genuinely complex, interconnected area. Pulling one lever, like where you hold your bonds or when you give to charity, changes what's possible with every other lever. This isn't personalized tax or financial advice. Everyone's numbers, goals, and account mix are different. But this framework should give you a real sense of what a coordinated retirement tax strategy actually looks like in practice. If this made retirement tax planning feel less like a mystery and more like a solvable puzzle, that's exactly what this channel is here for. Hit subscribe, because I'll be covering more real-world tax strategy breakdowns like this one going forward. Drop a comment and let me know which of these strategies was new to you. I read every comment, so I'll see you down there. This is Sara Retires. I'll see you in the next one.